Gopal, good morning. Thanks very much for joining us on Bloomberg Quint, India's first digital live streaming business news service. I'm Menika Doshi.
Yep, this is Bloomberg Quint Mornings and you're watching Indian Open. Good morning to all of you. I'm Neeraj Shah.
Good morning, I'm Meera Dugal. Let's get straight to the headlines. We've got the Asian markets opening higher on optimism that Donald Trump's tax cut plan could give a boost to the economy. September could be the worst series in nearly a year for Indian futures as it tests August lows of 9,685 on expiry today. Gold prices slipped below their 50-day moving average for the first time since July as the dollar index hits a one-month high. And the rupee set for the worst month of 2017 as growth and fiscal concerns continue to pull the Indian currency lower.
Well, let's take a brief look at the trade setup for the day. The Asian markets, the SGX Nifty will come up on your screen. It's a mixed bag. The handover from the US markets wasn't the worst, but we're starting off probably on a flat note yet again. Keep in mind though, the flat starts haven't really kept the Nifty from succumbing to some selling pressure towards the course of the trading day. Today could be no different. Bank Nifty sub 24,000. Let's wait and watch expiry day as well. And keep in mind the key point being that the Nifty is sub the 100-day moving average. It happened sometime during the closing hours of trade yesterday. Let's wait and watch if there is indeed further pressure on the markets. And the fact that we fell despite a 1,000 crore net purchase, the ferocity of the fall would have led one to believe that maybe, just maybe, the DI participation would have been very low and FIs would have been big sellers. Yes, FIs sold about 800 odd crores net sell, but the DIs bought in about 1,800 crores. And despite this 1,000 crore odd net purchase figure, we ended close to or at the low point of the day. So the template of the market certainly, without any doubt, and I'm not saying something out of the ordinary, has shifted to a sell-on rally from buy the dips, at least for the time being, and unlikely to change. The other key thing is that the September expiry, if we end at the current levels or lower than the current levels, would be the worst expiry in FY 18 for sure. None of the series since April have actually had such a bad performance. So it just sums up the mood of the market currently. What to watch in today's session? I think a bunch of stocks, specifically the mid-cap space, would be on track because the large caps are doing only one thing, and that is correcting. So Cyient, remember, corrected quite a bit in trade yesterday, but the block deal has a bunch of very interesting names which have checked in, including Amansa Capital. This name typically evokes some bit of buying. Let's see if Cyient stabilizes in the session today. BEML and Reliance Capital, two stocks which have corrected thick and fast the last few days, are now out of the F&O ban. Let's see if there is some stability to those. In HDFC Bank, I was just doing some analysis or just some comparing the Nifty fall versus the HDFC Bank fall. They've been parallel, 5% for HDFC Bank from the highs, 4.1% for the Nifty from the highs. And it's been the key contributor to the Nifty fall, but across the board, across brokerages, this is that one stock that is coming out as the top buy. Whether it gets bought today or over the course of the next few days remains to be seen. But this is a monitorable. It is dragging the Bank Nifty down as well. Let's see what it does on the expiry day. So it should be interesting, HDFC Bank in today's session.
All right, that's what the markets are looking like this morning. Let's get you all the big stories that Neeraj, Ira and I want you to focus on First Word. Most market participants seeing the Nifty fall another 200 points and the banking sector bearing the brunt of that fall. That and a lot more takeaways from the Bloomberg Quint market poll. We also talk about what may have caused the rupee to weaken and the fact that the central bank has not really intervened this time around. And great expectations. Morgan Stanley bets on big data to forecast the Sensex at 1 lakh. That's in the year 2027. But we'll get down now to the market poll.
Absolutely, that's top of mind for everybody. The Nifty has just posted its longest losing streak this year, with the benchmark index declining by close to 4% over the last 7 trading sessions. So will the sell-off continue, and which sectors will bear the brunt? We did a quick dipstick poll among 7 brokerage houses and market participants. Neeraj, what's the prevailing mood out there?
Well, bearish, if you can call it that, Ira. But it's interesting to see that almost everybody unanimously has given one verdict, and that is that the market fall has got almost nothing to do with the geopolitical tensions. Those are a thing of the past. Remember, we were talking about this yesterday on First Word as well, that if you cry wolf a number of times, then people will stop worrying about that. And I think that's led to this response as well. So 43% of our respondents say that valuation concerns are the key reason why the market has fallen the way it has. And the volatility due to the expiry and due to all that's happening in the markets currently, maybe due to valuation, maybe due to the economic concerns is also a part reason for this. In fact, two of the respondents mentioned that we might actually see a bit of a stability once this series expires. I don't quite understand the rationale there, but let's wait and watch if indeed that happens. The other interesting bit is about the downside for the Nifty. Now, the key is there is a bit of a majority out here. 57% of the respondents believe that the maximum downside for the index is about 200 points. A few people in favor of even less than 100 points as well. I don't know if this brings in the trading angle out here, but when we asked about what the view is over the course of the next 3 to 6 odd months, 57% of the respondents believe that the downside to the index could be about 200 points or less than that. Over 500 points, that's about a third of our respondents. However, a bit of a minority. Where is the downside seen? Whether it's 100 points, 200 points, or 500 points, or over 500 points, whatever the downside percentages may be. But when quizzed about what are the spaces wherein the downside could be seen at, I think there is an overwhelming majority which is betting on banking and NBFCs, and a bunch of people talking about defensives as well. The interesting bit is, we've been talking about this, that consumption remains the driving force of the market on the upside. Some of these consumption-related stocks are overvalued, but nobody believes that this is a bucket that will correct. So I believe the mood out there is that if there is anything that can pull the market up, it is the consumption space. Therefore, don't bet on that on the downside. For the downsides, look at banks and NBFCs. They are probably overvalued, so go out for them. And look out for defensives as well. They haven't, in a manner of speaking, corrected too much. Maybe they could correct now. So that's the third response. And last but not the least, how long before the recovery? This is an interesting one. Nobody believed that it'll be over 6 months. So for people who might be predicting doomsday and thinking that now until the next 1 year, we'll probably not see any signs of recovery, that theory is out. Majority of the respondents believe that we will recover. Whatever levels we go down to and whatever those individual levels may be, but we will recover in less than 3 to 4 months. About a third of a percent, or slightly less than a third of a percent, maybe a quarter of a percent of the respondents believe that it'll probably take about 6 months, slightly less than 6 months or around 6 months for the recovery to come in. So some people pegging March to be the case, some people pegging December or January to be the case. So that's the timeline with which people are working with. Almost no one believed that there will be a recovery that will happen immediately. So even the 100-point respondent who mentioned that there could be a recovery in less than 100 points downside being seen, even they believe that the time taken to recover would be at least 3 months, maybe even 6 months. So this I found to be the most interesting bit, that even if we don't have a large price-wise correction, we will certainly have a time correction to the tune of 3 months, 6 months, maybe more.
The uncertainty around the economic recovery, right? I mean, if you don't feel the animal spirits are back in the economy in any measure whatsoever, how are you going to be optimistic about earnings, or how are you going to be optimistic about anything else in that sense? So I suppose time is the only thing that will help heal that.
Yeah, and two of the respondents that I spoke to personally pretty much mentioned that as well. Nobody's talking about the geopolitical tensions. Everybody's centering squarely.
Domestic concerns. Also, I think that there are specific reasons for why they might be waiting for some time. You will get a better handle on the government's finances in some time, as we've been discussing with regards to government revenue. So you'll have a better idea of any stimulus, if at all the government can afford one, in some time.
Yes.
So maybe that's why you're deferring your, hope of any kind of recovery by a few months, saying, let's see if all of this works to, sort of scheme or plan, then maybe things will look better in 5-6 months from now.
There was one question, Ida and Menka, outside the poll, which I asked them, that when you're talking about this time frame exactly that we're speaking about, why is it that you need this time? Is it the budget? I just slipped in the question whether the budget is something you're watching out for. Everybody said no. People are saying no, budget is not the key. Before the budget, what the government will do, everybody believes that what the government will do to stimulate the economy will be outside the budget, and they'll probably need to do it well ahead of the budget.
There's only one thing pending. I know I briefly mentioned it yesterday, but if you remember 2 years ago, Arun Jaitley had mentioned that he will take away exemptions in taxes, but he will also bring the rates lower, right? Yeah. And last year, or this year's budget, he did make adjustments to some of the lowest personal income tax paying slabs, but the big cuts in corporate tax have not yet come through. So that's still one lever, but I suppose he's not going to use it unless he has some degree of certainty around GST revenues, right? So the moment he knows that this is going to help me expand my revenue base, GST that is, he will then probably feel a little bit more comfortable in being able to grant those tax cuts. And that could, in fact, be a good boost in terms of both sentiment and actual bottom lines, you know.
Let's wait and watch.
Yeah, let's wait and watch.
Yeah, so I think, the next 3 to 6 months will be crucial for the currency. Of course, the next few days will be crucial as well. We've seen the weakness persisting in the Indian currencies. There's nothing alarming about that. The Indian currency is correcting. It's correcting on a slight change in the macros. It's also correcting on fund flows. Yesterday, just briefly mentioning technicals, although, not a huge believer of technicals on the currency, but it did break the 200-day moving average. That was around 65.51 levels. And a lot of people said that when the central bank did not come in to protect those levels, then there was a further downtick which took the currency intraday to about 65.72 or so. There was no large intervention seen by the Reserve Bank of India, but if you remember, even on the upside when the rupee was appreciating, the RBI in the Urjit Patel regime have preferred to be a little bit more hands-off than the Raghuram Rajan regime. There is, of course, still questions around the fiscal data, growth numbers, those have been sparked off. So until there's some sort of a clear comfort coming from the government that they won't breach the fiscal deficit numbers, perhaps the market would remain a little bit on tenterhooks. Today is an important day also because the second half borrowing calendar will be put out. Not sure that in the borrowing calendar you'll get much surprise, but let's see if the numbers are anything more than what people had expected. I just want to quickly, before I get a view in, put out the fact that, while nobody can say that the currency will never go into a downward spiral, these are very sentiment-driven things, but should a scenario like that emerge, please remember that we are well positioned in terms of forex reserves.
Yeah.
We've built $120 billion between 2013 and now. In fact, if you take the forward positions, perhaps a little bit more than that, 400 billion is what we're sitting on. So if I was the RBI sitting there, I would just particularly say that, okay, I'm fine with the currency right now, but when I need to come in, I have $400 billion at my disposal. Just one point, reserves are adequate, certainly from the import cover perspective. We're at about 11 months of import cover, but there was an interesting point that Bank of America Merrill Lynch had made in a report about a month or so ago. They had pointed out that portfolio of foreign investments is now at 120% of reserves. Just putting that out there, nobody is saying that there's going to be rapid unwinding of the foreign portfolio, but reserves can be looked, or the adequacy of reserves can be looked at in various manners. Arvind Narayan is joining us from DBS India for a quick view. Arvind, sorry for the early morning call, but thanks for taking our call. I just want to ask you a quick, I want to get a sense of what the structure of the market is. Are exporters expecting a further decline and hence holding off? Are importers sort of buying in the anticipation of further decline? What's the structure of the market right now?
I think currently how it looks like is we're seeing importers coming in more like a stop-loss buying. These are the people who had been confident that the currency has been behaving itself and they didn't need to spend so much premium on currency protection. We've seen that view changing on the importer side and we've seen them coming in and buying. The view on the rupee has been that it will probably weaken for some more. I don't think it's going to be a runaway depreciation on the rupee. But looking at the other emerging markets and Asia, other Asian countries around us, it does look like rupee could weaken a bit more, which is why importers are coming in. However, exporters have been quite happy. I think they have been complaining all this while that they're not seeing much depreciation. This volatility is kind of a welcome benefit for them. Most of the large ones haven't gone into the market and selling significantly, which means we expect the market to weaken a bit more, the rupee to weaken.
What would be the levels you're watching for, Arvind, from here on?
Actually, very clearly speaking, I think the 65-80 kind of levels which we saw yesterday is definitely one big level. Second level to me is what we saw before the UP election, which is about 66, 25, 30. So I'm in the camp which believes that not too much of a runway depreciation is left. So probably at about between now and 66.25, you will see a lot of selling coming in. I think people are also targeting kind of stop-loss levels at 66 levels. In the offshore markets, you have some barriers at 66 levels. So I think the markets will try to take out those levels. Once that happens, I think the rally should kind of fizzle out and probably lose steam, and you'll see exporters coming in. Probably you'll see some central bank action happening if the volatility is very high, and that should bring back the rupee towards, again, the 65, 60, 70 kind of levels.
Arvind, just a quick word on the central bank stance. I know it's always perceived intervention. Nobody really knows until, about a month or so later how much they've been intervening. But I think just as in the upside, even in the downside, the RBI has not been that sort of active in the market from what I hear.
That's true. So they haven't been selling aggressively in the market, and their stated view has always been that they are not here to protect a particular level. They are here only to smoothen out the volatility if it is not in line with peers. So I think in that context, if you look at the past few months when rupee was very, very stable, despite all the negative news around it and despite some of the other Asians and emerging countries weakening, this weakness is actually kind of catching up from the rupee's perspective. So I don't think the RBI is going to be unduly perturbed by the levels. They would be watching it for the pace of depreciation. So as long as the pace is reasonable and it's in line with what's happening and the news around us, I think they'll be okay with the gradual weakening of the rupee. But if you see a tremendous kind of speculative weakness on the rupee, then that's when I think they'll probably come in and sell dollars.
Absolutely. And the fiscal stance will be, anything that would be the key determinant. If anything, it would be the fiscal stance?
I think the biggest, actually, one of the spoilers of the mood has been this talk about the fiscal stimulus and what it will do, right? So you've already seen negative news coming in terms of corporate earnings. You've seen private capital formation not really taking off. And more surprisingly, you've seen a lot of the larger industry captains saying publicly that they do not see significant recovery for the next 12 to 24 months, or GST and demonetization has kind of put a slowdown to the recovery process. Suddenly, on top of that, you had this whole talk about the fiscal stimulus being planned. That's kind of negative, and we've always seen the FPIs pulling out money, especially on the equity side over the last few months. Now I think the debt side could be a bit of a worry, because any fiscal stimulus would mean that we breach the fiscal discipline, and that could mean that rates could go higher, and that's not good news for the FPIs. So now in October, the limits have been opened up. You can see another $5 to $6 billion being added up because of the changes in regulations. But if they are worried about the fiscal position of the country, then I think the inflows is not going to happen as fast as we expect.
Okay, got that, Arvind. Thanks so much. Appreciate you taking the time to speak to us this morning.
All right, I'm going to argue that both of you are very gloomy this morning. I spent an hour in the Morgan Stanley office in the very same building yesterday, and man, I couldn't, there was nothing I could do to take away from the optimism. So let's bring some of that cheer here into this studio as well. Get ready for the Sensex at 1 lakh. And if things go well, maybe even 1,30,000. Morgan Stanley has great expectations of the Indian economy based on the JAM plus GST combination. And let me explain that. Now, this is the subject matter of a 125-page report led by Rhythm. And there are about 20 contributors to it from across the world, including the India team. So there's no way I'm going to be able to bring you all the details in the next few minutes, right? So I'll just give you the key takeaways, and then I would urge you to go to BloombergQuint.com and read the rest over the course of the day. But the big thing they're betting on is the digitization of the economy. So you've got the JAM Trinity, you've got GST, and between both of these, they're saying that we will end up creating significant big data in this country. Big data on taxpayers, big data on tax habits, big data on cash flow for companies, big data on bank lending, big data on personal credit. So all of this put together will mean substantial gains, or how do I put it? Not substantial gains, but big boost to credit flows and substantial gains for the economy. Let me break that down a little bit and give you some key takeaways. For instance, the report says that they expect that lending will move from collateral-based lending to working capital-based lending. So because this big data will allow banks to keep track of the working capital of firms over extended periods of time, small and medium enterprises will find it easier to be able to get credit at cheaper rates, and therefore rates of credit to that part of the economy will grow and grow as substantially as 17% CAGR. So that's one key takeaway. Big shift in credit culture. And so they expect that consumer credit will also grow very rapidly. The growth rate number positioned for that is also 17%. And let me add here, these are all projections for 10 years, so 2027. Anytime between now and 2027, some of this could become true. Higher government revenue, thanks to GST, once it stabilizes and all of that, will mean a lower public debt to GDP ratio, which is a salutary impact on the economy. E-commerce sales, they say, will touch 200 billion in terms of GMVs by 2027. And they're positioning India as a $6 trillion economy in the next 10 years. So that becomes the third largest economy in the world. And this will be a big driver for the equity bull market. Now, they've put in some forecasts. You may shrug, you may giggle. These are 10-year forecasts, and we're struggling right now with 2-month forecasts. But this is what they're suggesting the economy will look like. So they're saying, like I said, GDP will, come in somewhere around $6 trillion. Mutual fund AUMs. So currently 273 billion. Their bull case for 2027 is $3.415 billion. This is, or 1.93. Okay. Sorry, I mean not 1.93 billion, substantially 1,935 billion, right? Sorry, and 3,415 billion. Yeah, so that's what they're positioning for mutual funds. They've got lots of data out there. I won't take you through all of it, but I'll take you to the number that everybody will be watching, which is the Sensex, currently at about 31,000 levels. Bull case scenario, 1,30,000. Base case scenario, 1 lakh. Bear case scenario, 65,000. So that's the view out from 10 years. And they've also put in a list of stocks they like based on this entire stratagem, if you may call it that. And let me take you very, very quickly through what that list of stocks says. I'm just pulling it up for you. There you've got it. You've got both financials, so those will come up, and on top of that list is Bajaj Finance, Edelweiss, HDFC Bank. They've got housing finance through LIC Housing Finance. You've got ICICI Prudential for the insurance play, M&M Financial. So financials is the big pick, and then they've got consumers, which is the second big pick. So you've got Asian Paints, ITC. These are all stocks that Morgan Stanley believes will benefit from these trends that they've laid out in the report. Eicher Motors, Maruti Suzuki, Ultratech Cement. So that's the Morgan Stanley 10-year strategy. I'm not sure we'll be around in 10 years from now to check if any of this comes true.
Of course we will be.
Okay, yeah, maybe.
Let's be bullish.
Yeah, well, but we'll get a chance to talk to Rhythm about this. So it'll be interesting to see how he explains some of the findings of this report.
I don't know what stood out for Ira. What stood out for me, and I'm just straight away going to the last part of this report that you highlighted, Menka. It's all about banking and consumption. There is, I'm sure there are others, but in the large list, there is but one economy-facing company.
You know, I asked him this question when we were talking about this yesterday. They had a select group of journalists over to talk about this, and I said, "What kind of list is this that you're talking about? If Bajaj Finance tops the list and ITC is in the consumer pack, this is hardly even a list to talk about, right? Yeah. I mean, some of us could put this list together without help from Morgan Stanley." So he did admit that they are constrained by market cap parameters, because these are the recommendations they make to their clients. And so therefore they don't recommend stocks that are below certain market cap parameters. Yeah. So therefore, and then he had some valuation concerns as well. So I think, when asked why ITC and why not maybe any other consumer goods, consumer company, I think some he had an issue on valuations, others he thought in market cap terms were too small.
I think what was strange to me is that in all of this, they don't have, except for perhaps Ultratech, which you could consider a play on the
real estate
story. They don't have anything which is investment facing.
Yeah, investment.
To me, it's absolutely confounding. I mean, I completely get the consumer story, but the investment story has to pick up, otherwise we are in a lot of long-term trouble.
So I think if you look at the NBFC and the bank play and the financial services play, maybe the only
all
exposure to investment.
Guys. Yeah, but they're all
HDFC is consumer.
HDFC is consumer.
Life insurance
Bajaj
is consumer.
ICICI Pru is consumer. Kotak is consumer. If they put an ICICI Bank, an Axis Bank, or an SBI in there, I would have said, okay, maybe they're playing the investment theme through that. So I mean, it's just it's strange. Nobody wants to play the investment theme, and India without investment is not going nowhere.
All questions we will put to Rhythm Desai, I'm sure, at some point. But just to, I know because we debated this with him quite a bit yesterday, I suspect this list has more to do with the theme that they're talking about, which is digitization, therefore a big move in corporate credit, personal credit. But yeah, investment.
It has to come back to investment.
Investment, yeah. And real estate didn't because it was market cap parameters.
No, but one simple point out here to play the devil's advocate. It may not mean that they don't have those plays in their priority list, but it may not be the top performing companies over 10 years.
Oh, by the way.
And therefore, this is a list of their top performing companies.
Over 10 years, right? So, so the point is that if you're expecting consumer consumption to pick up, demand to pick up, and investment has been slow, so investment companies have not seen the kind of traction that consumer companies have, then the upside should actually come on investment companies.
But their models might still be showing, Ira. I completely get your point, but I'm just playing the devil's advocate. The models might still show that over a 10-year period, Bajaj Finance could still outperform, for argument's sake, a Larsen & Toubro. Is my limited point.
Could very well. Look, who knows what happens in a 10-year period. But look, the guys at Morgan Stanley have been working very hard because they also put out, along with this 125-page 2027 report, a 12-month view on the economy, rupee and equities.
Is that positive?
Yeah, it is.
It is.
So yesterday, Rhythm said that he thought the economy had troughed out.
Wow.
And he said that, in fact, he thought that there were signs of recovery even before demonetization last year. We have some of those pointers on a graphic plate. It's also on our website, BloombergQuint.com. I can very quickly take you through what they've said there. So they've said that the economy has troughed out. We can expect strong earnings growth. We should expect strong merger and acquisition activity. This is something he's been talking about for many, many months now. Meaningful uptick in equity supply. The global bull market as the backdrop helps in, feeling more bullish about equities. And then this is the quote from the report. We also don't think the market is pricing in a multi-year growth cycle, implying meaningful upside potential to stocks over the next 3 to 5 years. So they're bullish on the 12-month period. They're bullish 3 to 5 years. They're bullish 10 years. Right now, everything's looking good at Morgan Stanley, right? And then they've put a list of stocks to avoid. Now, that's a very interesting list. We won't give it away on this show. You'll just have to take the effort to go to our site, which is BloombergQuint.com. And there's a list of stocks to avoid on a 12-month basis that Morgan Stanley has put out. So you can go take a look at what they think you should be underweight on. Yeah, that's it. That's the Morgan Stanley view.
Interesting one.
All right, I think that's all we have on First Word today, but stay tuned to Bloomberg Quint. On Market Open today, we've got views coming in on the mutual fund sector as well. We'll talk about whether the market correction will continue or not. That's Jinesh Gopani of Axis Mutual Fund joining us with his thoughts.
We also have pharma sector concerns with Ramesh Swaminathan of Lupin. And then, of course, festival season conversation continues. Today, we've got for you Gopal Mahadevan of Ashok Leyland. And that's not just a check on the festival season, more also a check on the underlying economy. All of those top conversations coming up in just a bit.
Yes, indeed. But for now, full tilt towards the day today. And it's an important one. We have subbed the 100-day moving average. But more importantly, it is that time of the month wherein we are faced with the Thursday. Could it be a terrible Thursday or a terrific Thursday? Navneet Saluja is joining us with a snapshot of the derivative space. Navneet, good morning.
Hi, Neeraj. Good morning. Well, all the key levels are being breached in the past few trading sessions. Even if you look at Nifty, Bank Nifty, as you rightly mentioned, both of them are trading below their 100-day moving average. And if I go by the series, both the benchmark indices are down for the September series, and this could likely be the worst series that the markets have seen since November 2016. And remember, November was the demonetization month where Nifty fell almost in that range of 600 to 700 points. If you look at the key levels to be watched out today, watch out for the August lows, which is almost 96.85. So that's the support which market will be watching out today. But important to highlight, there's been aggressive call writing in the system in the past few sessions. And look at the Nifty PCR. It's fallen below that level of 0.99. When was the last time that we saw Nifty PCR falling below that? It was on June 28th. So this is the PCR is the lowest in the last 3 series that we've seen. Even the Bank Nifty PCR fell to levels of almost 0.66, telling you that the bears have taken control of this market. Now, it's very difficult to tell you the range where the expiry could take place because the action is only on the call side. Let's see what happened yesterday then. 97.50 call strike added almost 15 lakh shares. If I have to go with the premium of almost 28 rupees, the call writers will be safe till the time Nifty reaches that level of 97.80. Let's see if that level is breached today or not. What are the FIs doing? Well, nothing changes for them. They're again taking more of short positions. Yesterday on the index futures front, they added 2 shorts for every 1 long, and the net longs have come down to almost 50% versus 72, which was seen at the start of the series. Even on the index options side, they're adding more of puts and they're writing more of shorts, clearly telling you they are heavily short in the markets as of now. In terms of stock futures, as we mentioned during our closing show yesterday, GMR Infra has actually entered into the ban period. The stock was down almost 3.6%. Expect some volatile moves coming about there. BEML, Indocount and Reliance Capital are the ones which will be in focus, as all three counters are out of F&O ban. Lastly, just one more counter, Siemens will be in focus. The stock's trading below all its key moving averages, and yesterday that fell sharply, and we did see some sort of short build-up coming about for the October series.
Talk to Abhijit Pathak about that. Navneet, thanks so much for joining us and giving us a quick snapshot of what's happening in that space. As usual, every morning on the F&O picture, Abhijit Pathak of Definet Solutions joins us on Bloomberg Quint. Abhijit, good morning. Thanks so much for joining in. A bit of a dampener yesterday. What does yesterday's move mean for the expiry today or for the short term?
Yeah, for the expiry, it's quite difficult to say because, like Navneet was saying, a lot of supports have been breached. But then I'm still not worried about the medium-term bull run. This might be just a correction. So I don't think there's anything to panic about. But for the short term, right now, it's a bit risky to take positions in long side on the futures and options side, rather future side. Options is possible because there's, the last month's low is 96.85 and this 97.10. It's a good support band. So there can be a base building here, and then one has to see whether bulls have any interest in taking the market up. So it's a couple of days of wait and watch.
Okay, wait and watch. So what about the expiry today, Abhijit? What should an average trader do?
If it goes near 9700, one can try a 9700 call. Or maybe again a October 99 or 10,000 call. But then again, it should be a very small position. It should not be risking too much.
Okay, so Abhijit, in a very small position, if you indeed want to trade, if you are a compulsive trader, then Abhijit Pathak believes that maybe buying the 10,000 October call near 40 or 50 could be an interesting one. I want to ask you about Siemens as well, Abhijit, but before that, you have a call on Divi's Lab. Very interestingly, you have a long call. Why so?
Yeah, because on the chart, 830, 840 is a good support level. So in fact, yesterday also it showed some buying toward the end. So if that is held today with a stop loss of 830, it can give a good bounce for the expiry, but maybe about 30-40, maybe up to 860 or 880. It's just an intraday technical bounce.
So this is an intraday call. You will square it today.
Yeah.
Okay. Last call, Abhijit. Have you looked at Siemens? Navneet was pointing out the short build-up, sub all key moving averages. Is there a chance to trade Siemens today?
Yeah, Siemens has a good support near 1200, 1180 to 1200. So that level, that band has to be watched. If that is held, there can be a bounce in the next maybe a couple of weeks. But I would be bearish on Siemens only below 1180.
Sub 1180 is when Abhijit would be bearish on Siemens. Thanks a lot for that, Abhijit. Good having you on the show. Over to Pradeep Pandya, though, for getting a sense of what the commodity space is telling us this morning. Pradeep, good morning.
Good morning, Neeraj. Looks like, traders in India won't really be bothered about what is happening at COMEX or London Metal Exchange or Shanghai. They'll be worried more about what's happening to Indian rupee, because you look at the dollar index and that has moved sharply, 93.5. That's kind of a 6 weeks high. If you look at US 10-year Treasury yields from 2.2 to 2.32 in a day, 12 basis points. Well, that's huge if you look at the bond market standards. So there will be some impact. The tax proposal that has come out in US and also the consumer durable data has definitely influenced currency. Now yesterday in India, rupee ended at 65.75. That's 1.5% move in just 2 days, roughly 3% down over say 15 days or so. So that is going to be interesting, because if you look at the commodities per se, there is not much movement. Gold is down some $10-15 because of the move in dollar index, but that is not much. If you look at other metals, there is hardly any move. But there are two soft commodities we should keep an eye on. One is sugar, that continues to fall for third day in a row, and then rubber, which has fallen by 6%, and in total I think it comes to around 18% in less than a month's time.
If only it was a market that was trending up, Pradeep. I think a lot of tire company trading guys would have had a.
Suppose today we are looking for stocks that could sharply bounce back from the lows, that could be one.
Maybe tires could be one. That's an interesting one. We'll talk to our experts about that as well. The other interesting one, Pradeep, though, is our poll. And I know Nikki's waiting, and we'll get to Nikki in just moments from now to talk about the IPOs as well. But it's the poll that we put out today, right? And the findings of the poll, very, very interesting. Almost nobody believes that we'll have a bounce anytime soon. 3 months is the time frame, even for the most bullish of people. Probably 3 months or less than 3 months. And there is a significant proportion of the respondents who believe that we'll probably take about 6 months to bounce. Now, I know all of these theories could be put out of the window. You never know what the market does. The market only knows what it does best. But it's very interesting to gauge the sentiment of the people in the street.
So that sounds pretty much like a bottom to me, actually. If everybody is so pessimistic, I think that's a time when market should bounce. I don't really mean to say that we have kind of seen the bottom in market, but at least in the short term, because market sentiment is fickle. It moves with index. Nifty is down 200 points yesterday from day's high. And you do a poll, the result is different from, if Nifty was up 200 points.
But I also think that a lot of respondents would be shying away from giving out a bullish comment right now, just looking at the text of the market. Maybe that's
But we never know.
We never know. Okay, it's no secret though. Let's just, before we move full tilt towards today, I think it's an important one to point out about the steady stream of companies that have been lining up to get listed on the exchanges this year. And while the buoyancy may have egged them on, they may also have been taking heart from the fact that some of the listing prices have set new records. The total amount raised from the primary markets has already crossed an all-time high, with more than 3 months remaining. Nikki Mirchandani is here with some hard numbers. Nikki, good morning.
Hi Neeraj, even as the activity in primary markets pretty much are, the secondary markets remains subdued, that in primary markets is pretty much euphoric. If you see the fundraising in the IPO market, it's almost at an all-time high level that we're looking at. So as much as 26 firms up till now have mopped up 37,477 crore up till now in 2017. This number is highest seen since that of 2010, where we saw nearly around 35,770 crore of money being raised up by as much as 59 firms. Now, if you see the bifurcation of how this money was raised, back on the second chart that we have, 66% of the money actually is coming in from OFS route, while 34% of that is coming from the fresh equity of fresh shares. Now, if you see, IPO has been clearly a good market for shareholders. If you just look at the 5 IPOs that have fetched maximum returns, now the success rate of IPOs is almost 59% so far in 2017, which implies that almost 24 firms that have tapped the markets, 14 of them have fetched a positive return right on the listing day itself. If you see the first 5 companies, now Avenue Supermarts, the IPO size 1,870 odd crore, got a subscription of 105%. Now, up till now, since the listing date, has fetched a return of nearly 260%. Next in the list, we have Shankara Building, which up till now has fetched a return of nearly 202%. Salasar at 141%. Even as the issue was subscribed by an overwhelming response of nearly 273%. Next in the list, we have CDSL, which up till now has fetched a return of 129%, and Apex Frozen, again a good IPO there, which has fetched a return of nearly 83%. But just when you thought that was it, a total of 9 firms will still be tapping the market to raise around 12,000 odd crore.
Interesting analysis. Thanks a lot for that, Nikki. I think the other key point out here, and just before we move to trade today, is that a bunch of money that was raised was via the OFS, but for the OFS purposes, and not really fresh money put into investments. And that takes the sheen away from companies having raised money for investing and creating new capacity, so on and so forth. It's actually money that has been pocketed by the investors. Nothing wrong with that, just bifurcating the color of the money between the for investment as opposed to for gains.
And we also had a huge amount of buybacks coming in, which means companies were investing less and giving out money more. So whether it went to the investors, to parent companies, to kind of support their balance sheet, or it went just back to the investor.
Yeah, it's not. Actually, Pradeep has summed it up really well. Nevertheless, let's move on to the trading day today. Hemant Thukral, head of derivative desk at Aditya Birla Money, joins us right now on the show. Hemant, good morning. Thanks for joining in. Key session today, expiry. What do you expect the index to do?
I think we all have been shocked, Neeraj, I'll put it this way, with the way the intensity of the fall has been. I think a lot of people, including me, were thinking that 9,800 should hold. So I think yesterday's fall has basically surprised everyone. Of that, we can give number of reasons. But I think the market should try to hold 9650, and I'll give you two logics behind it. First, 97 put in the next series has the highest OI, so we have to go with that. And today also 97 put in the expiry day will be trying to defend because that is where the highest put is. Secondly, there are two very crucial points which I was just checking. I don't know whether people track it or not, but India VIX is now at 14. Now, if you compare it with all the international volatility indices, they are actually at the lower end of the ranges, whether it is CBOE VIX or any other VIX. So this divergence has now been continued for more than 10 days. Now this is not, this does never happen. So that what it means is that Indian markets are completely underperforming the world markets. Now there can be some fundamental news which is affecting Indian markets, but the data is suggesting. And the second data point which is interesting is that last series we opened with a PCR of 1.35, which was a 7-month high. This time I think we might open below 1 because the call writers are really putting pressure at 10,000. So the PCR will be around 1 or maybe below 1, and VIX will be at 4 months at 14, which will be very different from the world markets. So I think you will see some sort of pullback coming in. These data do not remain divergent for a long time. And the way the rollovers are happening, Nifty and Bank Nifty rollovers will be below average. So that means further cutting of positions from the FI front in the indices. Stock futures, I think rollovers will be as per average. So we have to choose individual stocks that will continue. But overall, to put a sense of these all data points that I was trying to say, I see that today Nifty should hold. But
traders would be looking for some cues on how really one could trade the index on last day of the series. Actually, do you have any strategy?
See, I would bet for a pullback from after small gap down opening. So I would actually buy 97 call for the to expiry towards 97.80, 97.70. So my strategy would be that if you get a gap down, please buy 97 and keep a strict stop loss of 9670, 9675 on the same.
Okay. Now let's go across to our research team. Darshan, Shraddha and Agam are standing by with some of the interesting research reports that have come out this morning and also other cues, stocks in news. We'll talk about all that. To begin with, Shraddha, what is the top stocks in news this morning?
Well, Pradeep, good morning. To start off with GE Power India, and that's on the back of a contract win of about 327 crores. Now, the total annual revenues of FY17 for the company stood at about 3,200 crores. So that's 10% in terms of the likely size. You have Ashiana Housing, which is partnered with the Pune-based developer for a group housing project. Now, the saleable area for this is expected to be anywhere between 12.5 to 15 lakh square feet. We also have a news from Cogensis, which says that oil ministry is in favor of hiking ethanol prices by 2 rupees per litre for 2017-2018, and on the back of that we could have names like Praj Industries and sugar companies in focus. Praj of course has already been languishing at close to 2-year lows, and sugar companies also where sugar prices have continued with their downtrend, so this could probably provide some respite. And on the back of Baldi's, we're tracking Kajaria Ceramics, where Westbridge Crossover Fund has sold 18.8 lakh shares. That's 1.2% stake in the company. Last month also they had sold about 0.5% stake, and as of the June 2017 BSE shareholding pattern, they held about 7.41% stake. So they're probably pairing some stake in the company. So all of those names, Pradeep.
Okay. And Darshan, I seriously thought that HDFC Bank was an expensive stock.
Yeah, but I don't think Macquarie believes it, because they've raised their own target price by 27%. So now the new target is almost 2,200. So what they did was they met the management and individual, vertical heads, and now they're rather bullish after meeting them. So that is why they've come out with this report. But they're saying because of this meeting, this reinforces their view on the entire private banking sector, and HDFC Bank remains their top pick. Now, what they've said is the fact that the growth can sustain at these high levels, mainly on account that they their loan book is growing rapidly at over 20%. So that's the main point that they're pointing out, and that is happening because of the strong distribution capabilities that the company has, and also the diverse portfolio that the company has. Apart from it, they're saying that they still have the scope to penetrate into 1/3 of their existing customers with new products. Now, in terms of some of the concerns, the management transition they believe can be handled well. The IFRS transition, the margin, asset quality are no major concerns for them. As far as valuations are concerned, they believe that the EPS will grow at a CAGR of 21%, the loan growth will grow at a CAGR of 22%, and book value will grow at 17% CAGR over the next 3 years. And they're saying that the power of compounding story is intact for HDFC Bank.
Well, that's about HDFC Bank. But Cyient, this block deal yesterday, Agam, actually pressured this stock down by 8.5%, 9% in yesterday's trade. But it's interesting to see the kind of buyers who have come in.
Absolutely. I think the worry was because of the fact that one of its key investors, that is Carrier International, it's also a subsidiary of United Technologies Corporation, which is also Cyient's biggest clients. So they also give them a substantial amount of business. They went ahead and sold as much as 12.2% stake yesterday. But to counter that, there were a lot of funds out there, very large funds out there who bought stakes. So you had Amansa Capital, Birla, Sun Life, as well as Government Pension Fund, Global, and DSP BlackRock, for that matter, all bought into this thing. Credit Suisse is of the opinion that this development may not be a substantial, loss for Cyient, and they have maintained their outperform, and they also have a price target of 600, and they say that this will not hamper their business relationship. And moreover, when it comes to the company, it's structurally placed well with a very solid business momentum, which is why they are still positive when it comes to Cyient.
Well, thanks a lot, Agam, Shraddha, and Darshan for all these details. Meherboon Irani joins in for a discussion in our studio now. Meherboon, Cyient, to begin with, interesting to notice that Amansa is, of course, a well-known investor, but you look at the Birla Sun Life 95 is a top-performing scheme. You look at DSP BlackRock Small Cap, again a top-performing scheme. What would be your view on Cyient now?
You have a view on Cyient, Meherboon?
No, I don't have a view on that.
Okay, so Meherboon Irani, of course, doesn't have a view on Cyient, but the interesting bit would be keeping in mind that Cyient could be in focus today by virtue of the nature of the block deals that Agam was just referring to and Pradeep was just trying to ask Meherboon about. So that's interesting. Okay, let's talk about something that I'm sure, Meherboon, you look at very, very closely. Banking, the pressure that we've been having on that space in the recent past, and HDFC Bank, almost every sell-side large multinational brokerage is saying HDFC Bank is the top idea, yet HDFC Bank is the top contributor to the index fall in the last 5 or 6 days. What's happening here? When can this stop?
Yeah, I track it very, very closely. I think you need to understand the fact that this is a stock which has gone up too sharply in the last 2 months. It has contributed heavily to the Nifty. And where you have a time, for the first time in the last many months, you feel that complacency is getting a little bit disturbed. People are now sensing that every time the market falls, it doesn't rebound. A little bit of worry is coming in, apprehension is coming in. People are now spreading words, 9,000, 9,200 is coming. Where were all those voices just a few days ago? Have the fundamentals really changed overnight? At the end of it all, the point is all the front line stocks which have contributed sharply to the recent, to the last leg of the rally are possibly giving way. Now, what will I do with HDFC Bank and what should people do and why it's a buy call? Because in this market, and that is what I've been telling, and that is what I said the last time also I was here, that every time the market moves up, lesser and lesser stocks will participate. It's going to be very difficult to identify stocks which will outperform the indices from now on. And HDFC Bank certainly will be one of them. So if you see the Nifty possibly going to a 9,500 once before it possibly tries to go back to 10,000, you can see a HDFC Bank giving a little bit further way. But when you come to 10,000, I promise you, HDFC Bank will be higher than where it was the last time the index was at 10,000. And that is where the people are positive about it. And at the end of it all, if I'm having an HDFC Bank and going to sleep or watching a movie with my family, and I feel something negative is going to happen to the markets, I'm not going to lose my sleep and I'm going to continue enjoying the movie. And that's the greatness of scripts like HDFC, even for that matter an ITC. I think at this level, it's a 10 rupees downside and possibly a 50 rupees upside over the next 1 year. And I promise you will have more and more buy calls coming for ITC. And even if you track the Nifty over the last 10, 15 years, I think ITC has always been a contrarian as far as movement goes. So when the Nifty falls, ITC refuses to fall and starts showing signs of going up, and it will happen this time also.
You know, I love when Mehboon speaks with so much of conviction about something. The last time that I heard Mehboon speak about something with so much of conviction was Edelweiss, if I'm not wrong, Mehboon. The street had already joined the chorus. Now more and more participants are coming in. I'm sorry, I'm just slipping this question in since we're talking about banks. NBFCs and companies like Edelweiss, there might be near-term weakness. Should people use the near-term weakness without bothering about what levels could the Nifty fall to? Because there is a chance that the index could correct another 5-10% from here.
I will answer the banks thing, which I missed out. The banks thing, according to me, will give you one more trading opportunity. I think at the beginning of the year, I said 2017 will see at least 3 to 5 lovely opportunities to trade on the long side for PSU banks. I think 2 opportunities are behind us. We are just 4 months away, and I personally feel there will be one more great buying opportunity coming. Maybe if PSU bank stocks another 5-10%, it can rebound from that level by 20-30%. Coming back to your question on NBFC, I think selectively, I still remain positive. You can argue with me, Neeraj. Pradeep can argue with me, their valuations are very expensive. I'm not disputing it. For me, what is important is, will the stocks trade higher than where it is today? Now, if I think that the markets could come possibly another 5% lower, this stocks could be 10% lower. But somewhere between now and the 10%, 15% fall, I will be a buyer because I liked, say, a Bajaj Finance at 5% higher than where it is today. I liked it because I feel it will be 25% higher than where it was. So I think I'll make that much more upside. Similarly, Edelweiss. If the market comes down, can it go down all the way down to 240, 245, 235? It can, and I'll be a buyer at 250. Because I see the stock at maybe 350 to 500 rupees over the next 12 to 18 months. So the point is, in this market in which opportunities in good quality stocks are going to keep on coming, be a little bit of an investor, buy a little bit more. Say you want to buy 1,000 shares, buy 2,000 shares. Gives you a sharp up move whenever the market shows a rebound. Sell that 1,000, bring down your cost of holding and enjoy the balance 1,000.
Well, that's an interesting story. Actually, everybody is asking this question, what really to buy in this correction. So financials, banking is one that is top of your mind. Anything else you would like to mention?
I would say I continue to like stocks in which demand is going to remain robust and where the government is not going to divert at all from what it has been trying to do. And that is digital. I personally believe all the stocks which are in optic fiber, be it something which is in the eyes of a controversy right now called Himachal Futuristic, or a Sterlite Technologies, which is the best stock in the space, and even possibly a Vindhya Telelink, not to mention of Larsen & Toubro, which is also in optic fiber. I think all these companies are going to do robust business, and I promise you will come back to me over the next 3 to 6 months when I'm turned right on this, because I see a lot of orders coming their way, including a company like Himachal Futuristic. So will the stocks be 20, 30, 40% higher in the next 12 months? Certainly yes. But we need to understand most of the stocks have gone up. Himachal has gone up from 10 to maybe 35, is back to 25. Can it go down all the way to 18 rupees? Yes, before it goes back to 35 again. So you need to catch the stocks when the market's correct, when they come back, show some profit booking, weak investors get out, you need to go and buy into it. So digital is one story I continue to like. I continue to like cement selectively. Third is auto.
Okay.
And fourth is paper.
So let's talk about some of these other themes in a bit as well. But it's 8:50. Before we get into Hadrian as well, he joins on too. But it's 8:50, that time of the show, when we get you the Bloomberg Edge of the day. Jayesh Khilani has some interesting insight, or rather the terminal has some interesting insight on Reliance Capital, which Jayesh is bringing for us. Jayesh, what is the terminal telling about Reliance Capital?
Morning, Neeraj. So I've picked the relative strength index for Reliance Capital because that is one of the best trading strategies to follow Reliance Capital. So first, let's have a look at what the relative strength index is. So it helps you to measure the momentum behind the price moves. Now we have seen Reliance Capital dip from 800 plus levels to sub 600 levels in the last 5-7 days. And you also get to know where the oversold and the overbought region is. So a level of above 70 on the RSI is considered to be overbought, and a level below 30 is considered to be oversold. How do you interpret these? You go and buy when the RSI crosses 30 from below, and you sell when the RSI crosses 70 from above. Given that theory, let's have a look at the chart of Reliance Capital. Like I was telling you, in the last 7 days, it has corrected more than 20% from 800 odd levels to below 600, and this is where, as of yesterday's close, the yellow dotted line that you're seeing is where the RSI has dipped below the 30 mark. And in the last 1 year, there have been only 2 instances where the RSI has dipped below the 30 mark, one in May and the other one in November last year. Post that, what happened was Reliance Capital saw a significant upside from the as far as the stock price is concerned, and similarly, if the history is to go by, we could see some bounce back for the stock.
The efficacy of this indicator for Reliance Capital is strong, Jayesh?
Yes, Neeraj. So like I was telling you, the red one and the green line is where twice before in last 1 year the RSI has given you a buy signal, and if you look at the returns that it has generated, so that's close to 50% on the RSI. So you have to wait and watch what happens this time.
It's interesting. Thanks a lot for that, Jayesh. A stock which has been under pressure, me and Pradeep were talking about this yesterday as well, and day before yesterday maybe with Hadrian Mendonca as well. He, senior technical analyst at IFL, joins us right now on the show. Hemant Tukral is still with us. Hadrian, good morning. Thanks for taking the time out. Let me start off with this Bloomberg Edge indicator on Reliance Capital. I don't know if the normal chart suggests that there could be some downside, but the terminal is indicating that there could be a possibility of some uptick coming in after the correction that we've seen. What would you be doing with Reliance Capital, if anything at all?
Yeah, definitely Reliance Capital is actually looking pretty interesting. The analysis that you guys have come up with seems to be pretty interesting. As far as my opinion is concerned, I think there would be a little more downside before we see, a strong bounce back in Reliance Capital. Now, why am I saying this? Because if you see in the month of July, when the stock broke above the 580 zone, Reliance Capital has once again retested the whole rally that it has gone through from July till date. 580, 575 should be somewhere where one can actually slowly and steadily start accumulating. See, the fall in Reliance Capital has been too harsh and too fast. When there is going to be a bounce back, which I reckon is pretty soon, from here on, I think it is going to be a V-shape recovery in Reliance Capital. So definitely Reliance Capital can turn out to be a good short-term bet for traders.
Meherboon was mentioning PSU banks, and if you look at the performance, Hemant, actually in this series, probably PSU bank index is one of the worst performers, down roughly 8%, the data that I can check. What's your view? What kind of rollovers have you seen so far, and what's your call for the next series? Hemant, are you able to hear me?
Now I can hear you. I missed the voice.
Yeah, so my question was about PSU banks. The PSU bank index is down around 8% over this series. How do you see the rollovers, and what's your strategy on some of the leading PSU bank stocks?
Okay, I would answer it in 2 parts. First, the rollovers are below average. So very clearly positions have been unwinded. There is no short positions. Now sometimes it is negative also because shorts are automatic buyers. So it's a more of a position unwinding that we are seeing across the board in PSU banks. In private banks, I just wanted to add, because you were discussing HDFC Bank, there is also position unwinding. So banking stocks, still no signs of rollovers happening. In fact, there is position unwinding. Only exception bank I can put is Yes Bank and Axis. Axis is a slightly surprise, which has seen above average rolls, and Yes Bank also has seen far above average rolls. So apart from these 2 banks, every bank has seen below average and position unwinding. So I would not recommend right now PSU banks to be bought into at all.
Trade will you take on Axis or Yes Bank? Is it short or long?
See, I will put it this way, that the cost is positive. So I would take that Yes Bank rollovers are looking slightly better. I do not see Yes Bank going below this mark 340, 342. Axis Bank, on the other hand, the cost is very flattish. The only thing, one data point I can predict about Axis Bank is that 500 put writers are emerging. So if it doesn't goes below 495, it can outperform in this series. But within the whole banking pack, if I have to pick one bank, I will only go with Yes Bank.
Okay, let's quickly get in the stock recommendations. We're about a minute and a half from the pre-open rates. Hadrian, to you first, couple of calls, an Ajanta Pharma and a Union Bank.
Yeah, Ajanta Pharma is looking pretty weak, and the way the stock has fallen in the past week or so, I think the weakness is here to extend because it has actually broken down from an inverse flag pattern. So I think one can consider selling Ajanta Pharma. Keep a stop loss at around 1170 on the upside, whereas you could see somewhere close to 1100 on an Ajanta Pharma.
Okay. The other one, Hadrian, which is Union Bank.
Yeah, Union Bank too is looking pretty weak, and it is also broken down from an inverse flag pattern. Flag pattern breakdowns are pretty fast. Once the breakdown happens, you see stock prices correcting pretty fast. So from here on, you can keep a stop loss on the upside at around 129 odd levels, and play for a target of 120 to 118 in the short term.
Okay, Hemant, what's your top pick or the strategy on the stock you are tracking?
See, I have chosen two stocks on the buy side which I feel will be outperforming the market. One is Ashok Leyland. Reason well above average rolls, 63% positions have been rolled and cost has moved up. So I would keep a stop loss of 107, and I presume in next 2 to 3 sessions the stock should test 120. The other one is Bharat Finance. NBFCs continue to see aggressive rolls, but Bharat Finance has already touched 77. I am expecting rollover to pass 90%. So I would keep a stop loss of 910 here and a target of 970.
Okay. So those are a couple of calls. Hemant Tukral has already given his index strategy earlier on, wherein he believes that it might be a good idea on a dip, if it comes about, to go long on the 9700 and the 9800 call, as the case may be as well. We'll of course revisit these strategies once the markets open, but the pre-open rates about to kick in, bring up what the SGX Nifty was indicating, bring up what the Asian markets are indicating, and no surprise that we'll have a flattish kind of a start in the session today for the benchmark indices. The only thing is, the last few times that we've had a flat start, we really haven't had the markets behave that way. Over the course of the day, the markets have only succumbed to selling pressure. Let's see what the pre-open rates are indicating today. And here are the first rates that are coming in on the pre-open. Well, all over the place, about a 0.25% apiece for both the Nifty and the Sensex. I think these rates will stabilize a bit. They'll probably come off a little bit in the session, but the Nifty for now is showing about a 0.34%. I think these rates will change. Bring up HDFC Bank, bring up Reliance, which was a key contributor in the move yesterday as well. In fact, the top contributor yesterday. Let's see if that is stabilizing a bit. And then a bunch of other mid-cap stocks in news which will be in focus. I think that today the focus will be on banks. HDFC Bank, Edelweiss, yes, but HDFC Bank, State Bank of India, ICICI Bank. I think these were a couple of 2 or 3 names which looked very vulnerable yesterday. Let's see if these are stabilizing in the session today. For now, rates are all over the place. In a bit, the currency will also start trading, and we'll show you those rates as well.
And also RIL, I believe, because they have won the bid to procure gas from their own coal bed methane field, and this will significantly bring down their cost because they will be substituting domestic gas for the imported gas that they use as of now. So this would be interesting. Let's have a look at rupee also, because we just in the start of the show we are talking about what happened to dollar. Now currency is down 13-14 paise more, so we are heading towards 66 level. I think 66 is what some of the currency analysts were kind of mentioning early on when it started correcting, that this could be a target. So we are almost there.
Yeah, Arvind today was saying that 66 or 66.20 is where he believes there could be selling that could come in. So could be interesting. Let's see if that stabilizes here or no, Pradeep.
Let's hope that we'll finally get support at that level. Cyient is another stock we're talking about. Let's see how that stock has opened after the kind of big funds really bought into this stock on yesterday's dip. And okay, look at it, 5% recovery after a 7% loss, so not bad.
I'm not surprised. Amansa somehow, all the other respectable names, yes, but when Amansa checks in, people stand up and take notice. Not saying that this will mean that the stock moves up 4-5%. The pre-open rates are indicating that uptick. But 9:02, let's get in the top brokerage calls of the morning. Jayesh Khilnani joins us with that list. Jayesh, good morning. Once again.
Morning, Neeraj. So let me start off with Nomura on Ashok Leyland. They have a buy rating, or they have upgraded to a buy rating, and their target price has been revised from 90 to 140 rupees. Now they expect the medium and heavy commercial vehicle industry growth to recover to about 15% going into FY19. Back on the back of higher tonnage vehicle would benefit, and Ashok Leyland commands a 49% market share over there, so positive for Ashok Leyland. Now this is led by Ashok Leyland's revenue continue to grow by about 16% CAGR over the next 3 years. However, they expect that for FY18, the margins could be impacted because of higher commodity prices and discounting pressure and GST. So the revenue estimate for FY19-20 is, they have hiked it by about 9 to 10%. EBITDA margin estimate for FY19 is about 40 to 20 basis points, and the EPS estimate growth they have anticipated to be at about 3 to 17% over the next 3 years. The other one that we are picking up is Credit Suisse on oil marketing companies. Now they say that industrial fuel volumes have fallen about 10% from April to August in 2017, and because of this there could be some short-term pressure going on for these OMCs. The EBITDA from marketing constitutes about 30 to 45% for all the 3 OMCs that we have, and they have on the basis of this, HPCL has been downgraded to neutral and the target price has been cut to about 440 from 500 rupees. BPCL, they have an outperform rating, but the target price has been cut to about 540 from 570. And lastly, IOC, they have an outperform rating, target price of 485, that has been revised downwards from 505.
Okay, so these are some of the oil stocks to keep a watch on. Thanks a lot, Jayesh, for all the update. Hadrian, do you have any strategy on any of these oil companies or maybe RIL?
Yeah, definitely. Reliance is looking pretty interesting here. See, the fall has been pretty sharp from 860, 865 levels to around 799. Now, if you see, the rally for the past 3 months, the 50-day moving average has held on pretty strongly for Reliance. And yesterday it has also once again found support at the same level, around the 801, 805 levels. So, I think, I guess it is the right time where one can slowly and gradually start accumulating Reliance Industries. And if there is going to be a bounce back in the markets, Reliance is going to lead it from the front. So, your stop loss should be around 780, and you can play for an upside target of around, somewhere close to 845 to 860 on the Reliance Industries.
The other interesting one, and that's what I want to get Mehrbun in just a bit, is ONGC as well, because market analysts are actually turning bullish on ONGC. Majority of the experts, which on the terminal, on the Bloomberg terminal, have a buy rating on the stock. So what could be driving this relative optimism? Somit Sarkar is standing by with an analysis. And Somit, just wondering, as of December, it was split down the middle, if I'm not wrong. Now, not a single sell call from the sell side on ONGC. What's driving this?
Now, if you see that ONGC is the only stock in the Nifty 50 index which has more than 25 buy ratings and 0 sell rating, and this has changed for the company. Now, at the start of the year, 46% of the analysts tracked by Bloomberg had a buy rating and 13% had a sell rating, and 41 hold rating. Now, this has changed to 70% of the analysts tracked by Bloomberg having a buy rating, 30% having a hold rating, and no sell rating. So let's see what has changed or what has worked in favor for ONGC. Brent crude, that is the Asian benchmark, is trading at a 2-year high of more than $57 per barrel. Now, rising and high crude prices mean high realization for the upstream major, which will lead to rise in earnings. Now, according to Jefferies, every $1 per barrel rise in crude will lift ONGC's EPS by 3.2%. Second is the expected rise in gas prices. Now, gas prices are administered and changed every 6 months. Now, if you see from FY15 to FY18, gas prices have fallen by 50% to $2.48. Now, this fall in gas price has hurt the company's gas business and turned it loss-making. Now, however, this will change on October 1st, where the new gas prices are expected to come in. Now, this new gas prices are expected to come in at $3, and this will be the first hike in gas prices in the last 3 years. Third thing that could be working in favor of ONGC is clarity on HPCL's acquisition. Now, ONGC has clearly said that it won't pay any premium to buy government's stake in HPCL, and the acquisition would be done by the end of the year at prevailing market price. Now, this removes the overhang that was prevailing on the stock that it might add debt if it acquires a stake at premium. Now, Jefferies also said that this deal, this ONGC HPCL deal, could be EPS accretive and would not add any significant impact on ONGC's balance sheet.
Thanks a lot for that. Somit, Mehrbun, within this oil and gas pocket, what are you bullish on? Sell side seems to be bullish on ONGC.
Well, at the present levels at which they are, I think there was a time when I was quite positive on the oil marketing companies, but at the present level where they are, and if you allow me to include ONGC, you allow me to include Reliance oil marketing companies, and the entire companies get space. And if you ask me to select one company, I would select at number 1 Reliance Industries, number 2 Reliance Industries, number 3 Reliance Industries. And I agree definitely with the other person that if the market has to go up, it will be Reliance Industries. And if you ask me, I think the stock should see a 900 rupees price, which is an equivalent to 1800 rupees bonus price before the end of this year. And that is where I personally believe, and what I have been going on stating, that if you have the Nifty at 10,000, again, for whatever reason, I think the number of stocks which will be seeing a new high will be much lesser than what we saw the last time, because it will be 2 or 3 stocks which will take the market. So for all you know, ITC from 250 may go to 275, and Reliance from the present level may go back to 880, 900, whatever, and you will see the Nifty at a new high. That is not ruled out. So I think Reliance will be the front, and everything is going in favor. I think Reliance is in a lovely sweet spot at the moment, including this ethane imports from US. I think that is also going to help them in a big way, plus the tie-up with BP. So I would say Reliance. Coming to your question about ONGC, I would put it at number 2. I think your experts said that, your analyst said that everybody has a buy call, because the stock has absolutely underperformed and there's nothing to lose from the present level. And if we have oil going up a little bit more, the stock could be a 5, 10, 15% from here, not ruled out. So when you have a stock, nothing much to lose. Like you asked me a question on PSU banks, what did I say? If the Nifty comes to 9,500, the stocks will be another 10% down. And from there, when they rebound, it will be a lovely trading opportunity. I'm not bullish on PSU banks as such. Sure. It's the price which makes you go and buy the stock. ONGC at the price, I don't see anything to lose.
Okay, you also said auto would be probably another sector that will go higher when the Nifty comes back to 10,000.
I think consumption is not going to be hurt in a big way as far as India goes, despite whatever damage GST would have done in the short term here and there. But I am also saying selectively auto. Like if you allow me to use a company like Escorts in the auto pack, I think I would stay with Escorts at number 1 right now in terms of valuation, in terms of what the company is doing, in terms of my understanding of the company, my management meet which I had some months ago. I believe Escorts will come up with numbers which will surprise everybody positively. So at the present level, I think Escorts has got at least 100 rupees upside over the next 1-2 quarters.
Okay, pre-open rates have settled. Let's just bring up what the indices are showing. The Nifty and the Sensex will come up on your screen. We'll of course get in some of the key movers as well, the likes of Sign. But let's just pull up the Sensex and the Nifty and show you what they're doing in the pre-open session. Flat as flat can be, not surprised at all. Maybe stocks like Cyient, maybe stocks like Praj and some of the others could be more interesting to look at. So these would be the stocks that probably we will focus on. Reliance and ONGC remain top draw as well. But let's tell you all that you need to know to stay ahead in trade today. The top 6 factors, the top 6 stocks and themes to watch out for. Macquarie has raised its target price on HDFC Bank by 27% to 2,200. They say HDFC Bank is the top pick in the private banking space. Watch this stock.
In Cyient in focus as investors like Amansa Capital, Birla Sun Life and DSP BlackRock buy into the company. Credit Suisse says recent price correction offers a good buying opportunity.
Nomura upgrades Ashok Leyland to buy, while Kotak upgrades L&T to an add rating. Nomura also upgraded LIC Housing Finance to a buy from neutral.
GMR Infra enters FNO ban, while BEML, Indocount and Reliance Capital come out of the ban.
Tire stocks in focus as rubber in Shanghai cracks over 7% to trade at the lowest level in a decade.
And Eris Life Sciences, Wakarangi, PNB Housing and S. Chan to meet analysts and investors today. So these are the stocks to watch out for.
Melbourne, very quickly, 30-second, 60-second answer. Tire companies, rubber prices have corrected. You selectively bullish on autos. Would you look at the tire stocks?
I think at the price at which they are honestly not very comfortable to add more. But MRF is one stock which we are holding clear disclosure, and I'm not selling it because selling a stock like MRF and trying to bank it 2,000 rupees cheap, I don't see anybody doing it on a practical basis, because a stock like MRF you never end up buying again. So we are holding MRF for our clients and no intention to sell, despite the fact that it could correct by 3-4-5% on the present levels.
Okay. You know, this new feature that we have introduced where by we tell our viewers which companies are meeting which of the big investors, and it kind of goes viral on social media every morning, Neeraj. Eris Life Sciences is one that kind of catches my eyes, because Tata Mutual, SBI Life, Island FS, ICICI Securities, some of the big names they are meeting today. Any views on Eris Life Sciences?
No, on the whole, the complete space It's a clear-cut no from my side. And I think, yes, I would like to compliment you all. Nobody provides the information the way you all provide about who is meeting whom. But I would also like to say in the same breath that is not necessarily an indication that things are good for the company or that they're going to come out of the buy report in the future.
No, never. Never an indication.
Exactly. So
it's not meant to be.
I personally have been negatively biased towards pharma, and nothing changes it. Despite the fact that at whatever level you give it to me, I'd say that the best for pharma is history now.
Okay. 9:13. Let's get in the top trading recommendations from both our experts. Hemant Thukral, to you first. If you had to bet on one stock for the day today, which one would that be and why?
Basically, as I suggested, I would still bank on Bharat Finance. I still feel NBFCs they have seen a decent correction, and second, the way the rollovers have happened, I feel Bharat Finance is forming a strong bottom at 920. So I think it is a good long trade on such days. So I think it will show good movement on the upside till 970.
Okay, so that's the call here on Bharat Financial. Some of the smaller stocks that would probably, one should watch out for. One is Mukund Limited, where promoters have bought some shares yesterday. There is one stock we should see how the stock really moves in today's trade. There is Lakshmi Vilas Bank, where board has approved a rights issue, and also Jan Irrigation, where a major investor has checked in with acquiring 3.6 crore shares. That comes to around 7.25%. So these are some of the mid to small counters we'll be watching out for. Mehboob, any thoughts on any of these?
No, honestly, Jain Irrigation highly fancied, but not liked it for other reasons, including a little bit of corporate governance here. The other questions which I have, which never get answered properly. As far as Mukund goes, I think there is basically grapevine happening that it may change hands as a company, which will. Such type of things normally happen when the markets are good, but despite the markets correcting, such type of rumors are going around. I would not like to put my money on such type of rumors.
Okay, Hadrian, quick 10-second call. Your top call for the morning, Hadrian.
Yeah, I'll stick with something like a GAIL because it has shown a lot of resilience at the time when markets have fallen drastically. So I think I'll go with the GAIL on the long side.
Right. Okay. These are the market trades at open. Nifty flat, Sensex flat, the Nifty Bank flat. So it's a flat start. This could be deceptive, keep in mind, because the last few days the indices have shown a tendency of correcting quite viciously towards the second half of trade. Let's see if these rates stabilize at the current levels or no. The broader end of the spectrum, the mid caps and the small caps too, would be flattish. Yeah, about 0.25% is really nothing to talk about. Let's pull up the heat map and see if there is more red or more green dominating the screen. At the start, well, a bit of an edge toward on the red side. Not too many gainers, I would presume. Tech Mahindra is the top gainer with about 0.5% kind of a move. But look at that red enveloping the screen. Now about 0.25% off, and the number of red ticks on the screen is increasing. Oil and gas seems to be in the thick of correction. So GAIL, ONGC, IOC, Reliance, all of these stocks are under pressure. And yes, as I said, there aren't just enough gainers. Just pull up a couple of stocks here before we move on to others. ONGC, IOC and Reliance, just trying to show that the pressure exists on the oil and gas space. So this is ONGC, down about 2 percentage points now. Analysts may be bullish, but it's coming off today. Reliance Industries should come on the screen as well, as should Gas Authority of India. And clearly the upstream companies and the gas distribution companies have some bit of pressure points in the session today. Let's see if these last or no. Aside of that, not too much on the index, but specific movers at the broader end of the spectrum could be the interesting ones. So Ashok Leyland, that's been upgraded to a buy by Nomura, up about 0.75%. Not a brisk start. You'll hear the management a bit later on in the show as well. Watch out for this. Cyient, wherein big funds have checked in. It's about 3% higher. Amansa Capital amongst the key ones, and that stock is starting off on a good note in the session today. The RSI indicators indicate a buy for Reliance Capital. It's a stock that's fallen almost 20% over the last 7 days, and well, a bit of an upside here today. We'll check with Hadrian if he indeed enthused enough to buy this or no. A small order win for GE Power, actually a big order win for a small company, so to say. This one is done okay. And ethanol price hikes could well be in the offing. The oil ministry spoken about this, and Praj Industries is starting off on a good note in the session today. What else, Pradeep?
Himachal Futuristic, that hits another lower circuit this morning. You also have Future Retail losing roughly 3.5%. Aurobindo Pharma and some more pharma names actually. Ipca Labs is one where we continue to see some selling pressure this morning. You also have 1% Beverage. The stock was down roughly 4 to 5% yesterday. Is down another 2.5% in morning trade. JP Associates is looking weak, and also Adani Ports. Adani Ports was the top loser among all the index stocks yesterday, and it has come off by another 2% or so. You also have GVK Power, ONGC, Godrej Industries, Biocon. These are some more losers in this morning's trade. 97.11, that is the level we see on Nifty. So Nifty continues to slip, and mid-cap also, if you look at, I think the selling pressure is kind of intensifying over the last 2-3 minutes of trade, if you look at it.
Yeah. So Mehboob, before we let you go, we've spoken about things that people can invest in. One stock that we didn't talk about this morning was Praj Industries. My question to you is, if indeed, every time this ethanol emission hike, etc., comes about, Praj Industries tries to rise and after that falls apart. Could this be for real this time?
Honestly, tracking this company for 10 years,
right,
and somewhere during this 10 years, completely gave up.
Completely
and
gave
for
up.
the reasons that you rightly mentioned, this type of stories keep circulating. Stock makes this move, but somewhere I got nothing against this company. In fact, I rate it quite well.
No, you can be honest,
but at the end of it all, if I'm invested in the stock 5 years ago, I'm still where I was. And somewhere you think that there are better opportunities available in the market, because money is always a limiting factor. So this stock, yes, from at the level at which it is 65, 67, 68, whatever, it may move up a little bit. But as a story, do I buy into it? Like, as I mentioned earlier, given up on this stock, so not interested, honestly, because this type of stories have floated in the past, but the stock has done nothing much.
Fair call. Mehboob, thanks so much for being upfront about it, and thanks for joining us on Indian Open in the session today. That's Mehboob Nadani with his views. Opening thoughts from Hemant Thukral and Hadrian as well. Hemant, your opening thoughts, anything that catches your eye in trade?
Basically, two points I think important. One, that Bank Nifty has come in green, which is obviously a very big sigh of relief. So it's respecting 23,700, 750 zone. And Nifty also is trying to take support from 9,700. Today's low is 9,708. And it's smart bouncely. I think there can be one more dip intraday, but utilize that dip to buy. As I said, I'm expecting expiry towards 97.70, 97.80. So that would be my thought for the day.
Okay, Hadrian, one final call on NBFC stocks. Motilal Oswal, Edelweiss, both have opened firm this morning. These two or anything else from this space you would like to pick?
I think, as I said last time, I'll continue to be bullish on DHFL, and I think it is one of the top performing stocks. It continues to remain in a higher top, higher bottom cycle, and I don't think so there should be any kind of huge breakdown that I see in the near term. So I think the decline that we've seen in DHFL should be a good opportunity to enter.
Fair call. Hadrian, Hemant, gentlemen, thanks so much for joining us today on Indian Open and giving us your thoughts. Look forward to having you more often on this forum. Well, the indices are flat. The mid-caps flat as well, but that's not a bad thing considering what we've done over the last few sessions. But can that change? And what are domestic AMCs doing in a scenario like this? We know that they've been buying, but what are specific AMCs doing? Jinesh Gopani, Head of Equities at Axis Mutual Fund, joins us right now on the show with his thoughts. Jinesh, thanks much for taking the time out and joining us today on Bloomberg Quint. Special week for us. It's a launch week, so thanks for taking the time out.
All the best to you.
Thank you so much. What have you been doing? I know shopping could be one word, but we also hear stories of how domestic AMCs, certain AMCs are keeping some gunpowder dry to be deployed at lower levels. Which camp are you on?
So we would be adding to the existing stories. However, there is an uncertainty. So some macro factors are not in your favor as of now. So oil, rupee depreciation, GDP numbers. So I think it's good for people like us who are long-term in nature in terms of investment, and you get an opportunity to buy the stories what you want to buy even again at the lower levels. So I think you had a good 9-month 30% return in the market, and obviously the flows have been pretty strong. But I seriously feel that there was a ripe for correction. The classic, I would say, instance would be IPOs not making money. So you were up for some kind of correction, you got a reason to correct, and there is some correction. So we are not perturbed by that, but obviously you have to keep in mind 2-3 factors that the near-term economy looks bit weak, and if it is only due to GST, I think next 3 to 6 months will be very critical to see how the GST gets implemented, how the real benefit of GST goes in the hands of the businessman and how they come back. So earnings number will not come by in Q2. It will be very truncated. Few companies like private banks will continue to do well, but then it will not be an across macro improvement. So we'll have to wait for December quarter again.
Sure.
So hope is always that the next quarter is going to be good.
Right.
So we'll have to see how see the problem has been whenever you see there is a stability, something comes. So you had demonetization.
Then you had
Again
GST.
that goes. Now you have GST. So all this factor, it's a massive reset happening in the country. So we have to live with that.
The question is, and by the way, we did a very interesting poll, Jinesh, a bunch of market participants, and I think those poll graphics will come up on your screen at some point of time, telling you what market participants believe would be the course of action over the next few weeks or next few months, if you will. But one key question is, the index rally, this is what the poll is saying. Let me just read it out. So what's led to the fall? An overwhelming majority believe that volatility due to various factors, I think that Jinesh was speaking about, and the resets are probably the major cause for the fall. So that is one. The second question was, what's the downside for the Nifty? And again, an overwhelming majority believe that another 200, 250 points could be the downside. A small minority believe that the downside will be limited to about 100 points. So that's the second question. The third question that we asked them is about where is it that people believe downside would be seen in? And a large portion of people believe that banking and NBFCs would be the key contributors to the downside, whether it's 100, 200 or 500. So that's the third question of the poll. And last but not the least, the question that we asked them is, when will the recovery come about and what's the time frame that it'll take? I think most people spoke about it being at least 3 to 4 months before we see the recovery coming in. Would those be your timelines as well?
Yeah, I think, as I said, that GST implementation is critical. You need to see how government is able to smoothen out the process. So November will be the first month of the entire GST cycle getting over. So if that goes well, if it is smooth, then there is no problem. But if it leads to some chaotic issues because of the glitches or various issues, then I think you will have to be really careful whether next 6 months are good in terms of businesses. So you need to be careful.
So if you think November, by November we'll be more or less clear about it, that means, December quarter results might get impacted. So that is just one quarter to go, and thereafter you...
So the December you have a base effect coming in because last year you had demonetization. So the numbers might look technically good, but overall you might not see a good number for 3 quarters as such. So you need those 15-20% growth momentum kicking in for the overall macro companies. I don't want only one company showing you 30% growth, but the larger companies don't delivering growth. Then that's not a good sign from the market perspective.
So you said you will be looking to add, on
So
on
wherever
declines.
we are invested.
So my question really is, you'll be you'll have to buy because there is a lot of cash lying idle because the kind of flows that you have seen, or is it a fundamental call that you really feel that at 9,500 market becomes cheap, if it falls 200 points,
No, I think,
go and buy?
see, with 30% gain, you need 5-7% correction is okay. You get healthy market then, because when there is a correction of 5-7% in, let's say, larger indices, you will have 15, 20, 25% correction in the stocks, which is, I think, a good level if you are confident on the stories where you are playing.
Which are the pockets where you envisage this 25% odd correction? I mean,
So
15 to
this-
25, whatever.
So, see, mid caps.
But that's a wide basket.
So wherever there are no numbers, you will see massive correction.
Where do you expect there will be no numbers?
So difficult to say because we have a very limited stocks which we really track from our investment perspective. But many places where there is just 5% sales growth. But people were assuming that things are good and things will just bounce back in next quarter, there you want to see some correction.
And what will you be looking to buy?
Same stories what we have. So we are still bullish on private banks, we are still bullish on select NBFCs, not all NBFCs. We are bullish on auto ancillaries and consumption sector. That has been 80-85% of the portfolio. IT and pharma we have been underweight. We'll look to add if we see the scenario improving, but let's see, the growth numbers are still not that great to go out and invest.
So financials on how much correction?
So NBFCs, for example, let's say 10-15% correction for my stories what I'm playing. Private banks maybe 5-7% correction because we are more betting on the larger companies who have a sort of a conservative approach to the growth. So that way.
Morgan Stanley has put out a very interesting note, and for the benefit of our viewers, if you do log into bloombergquint.com, you will see this very interesting story about the 10-year view that Morgan Stanley team led by Rhythm Desai, but it's a global team that has given out this note, and all the themes that they are bullish on. One thing that struck Jinesh out there is that from a 10-year perspective, it might be difficult to envisage 10 years, but they are betting on two pockets, which is banking and NBFCs and consumption. In a manner of speaking, some of the NBFCs are consumption-related NBFCs. Are you bullish at that side? The likes of, I mean, I'm not getting into stock-specific names, but the likes of Bajaj Finance and consumer-facing NBFCs?
Something like B2C.
Okay, that is where you're
That is where the theme, I think, overall world playing that theme, right?
Right.
So B2C is the name of the game.
Would the pseudo brokerages or the brokerages pseudo NBFCs fall in that pocket?
Obviously, but you have to be careful what you are buying.
Okay.
You know, while we were discussing that in the morning, I think Ira pointed out that nothing on investment theme, nothing on the capital goods and the core sector that, you know, Morgan is talking about. What's your view on that? Would you be a contrarian? You'll go in and buy capital goods now?
So we have capital goods in our portfolio, but very selective again. So I think that industrialization of the economy is going for a toss across the world. So it is not only India. You see in Europe, the way the large cap good companies are now merging themselves just to be not competing with each other and dying it down. So that the era of that B2B is as of now over, and the B2C has taken a front chase. If you take in 2007, your Nifty financial index was just 13%.
Sure.
Now it is 36%, which is also a cause of worry. So there is a financialization of the economy which is happening. The real economy then takes a backseat because money is going only in those type of. So if there is a QIP, if there is a IPO of any financial sector, people are latching onto it.
Right.
But if let's say for an example, if a manufacturing company comes, then there will be iffy. Okay, whether the growth is there, what kind of growth you want to play. So I think we'll have to wait. Government will really have to spend more. Private capex is not coming by. So it's a cyclical story, but we'll have to wait for some time.
What have you, if at all, what have you done on the recent IPOs? Have you been bullish out there?
Frankly, valuations are just too high. And that was a classic sign of not markets ripe for correction. Because when a company is coming with an IPO, it's a first time company is getting listed, it is getting a growth capital, it wants to grow. And then when the valuations are at a very stretched level, then you don't make money.
Right.
And I think the two good large IPOs did not see good subscriptions. I mean, what you could have seen, like given the brand name and all that things, which is not a good sign, I would say.
So we thought so about retail, you know, till the time we saw that fresh report from an FI broker, and we saw Amazon checking in on Shoppers Stop.
Yeah.
So what's your view on this space?
See, world is getting, I would say, distributed, destructive signs are across the board, disruptive business model. So Amazon is moving into brick and mortar. So maybe Shoppers Stop they would have identified as one of the play to play that way in India. So it's an interesting space. I think the business models are getting challenged every day now. So you have to be very, very careful what you are buying.
So do you buy retail? No.
Sorry?
Are you buying retail?
So it's a good space to be in, so I would say.
The other set of companies that have been on a bit of a run, have been on a good run in fact, are the commodity players and led predominantly by what's happening. I was reading a report yesterday that while there was no official stimulus from China, but there was some spending by China, a large number, and while that might be getting exhausted, another one could be around the corner. You don't know whether it will happen or it will not happen. What is your house view on how metals across the world perform and thereby the commodity linked stocks in India perform?
So very difficult to take a view. In fact, to be very frank, we don't understand commodity that great. There are only few stories to play, and that too you are dependent on many other factors, global factors, which decides the fate of that company. So we have been not being very high investors in those type of companies. We'd like to play stories where we can understand the business on ground. We can do our channel checks. We can understand what is happening in that sector, and then take a bigger bet on that. So to be very frank, it had a good run in 2016. The stocks prior to 2016 were down almost 40-50%. Again, they have reverted to the mean. China, again,
sure.
Black box in that sense. how much growth they will continue, how fast they want to grow again. So frankly, very difficult call to take on.
What about the impact that the high commodity prices have had on sectors? You mentioned you're bullish on auto hanks. All of those, the margins would be getting squeezed because of this.
So see, ultimately everything gets passed on to the consumer.
Is there enough offtake, you would reckon?
I think if macro is good and if macro bounces back, then pricing power is not an issue.
Yeah, but what about OEM suppliers? Because the auto companies will be squeezing their OEM suppliers, and therefore auto component margins could come under a bit of a squeeze, or no?
Possible. Depending on what kind of product you are manufacturing, depending how important you are. See, please understand, even auto ancillaries play a very significant role for the entire OEM to make the product.
Sure.
So around like 800 to 1000 parts goes into the OEM and car manufacturing, and most of them are supplied from outside.
Right.
So if that ancillary is supplying you well in time, just in time model, so why you want to squeeze them beyond a point?
Okay.
Maybe we will squeeze them, but might not to that extent.
I think we should quickly have a look at Nifty, because it slipped below 9,700 for a moment and it's now trying to bounce back and sustain those levels. Hemant Tukaral was mentioning this morning that 9,700 is where the bulls have dug in their heels right now, and there is significant build up not only in current series but also in the next series that will start tomorrow onwards. But let's see whether Nifty can hold this level. And also currency, we should have a look at what's happening to rupee that opened weak, down by around 12-13 paisa this morning. Rupee has lost roughly 2 rupees or 3.5% in 15 days or so. Jinesh, how does that alter your portfolio strategy, and what is the kind of level you'll be penciling in when you look to forecast earnings?
So few of my friends are in Forex, so they give us a view that 65, 66 is the good level RBI would like to maintain it. So going significantly below that, then it will have a significant repercussions on many issues, because we are an import-led economy. So they would not like to be taking rupee very volatilely. So there are enough reserves. You have $400 billion of reserves. You just have to pump in some money just to keep the levels. So I think that is what the friends are talking about in the Forex world, that 65, 66 is the good level for RBI to maintain it.
Last couple of questions, Dinesh, at least from my end. Financials have been in the thick of things. We spoke about the NBFC space. What about private banks? HDFC Bank and the rest are now seeing some bit of selling pressure because of the FI outflows. I would presume that would be the case. Would you be buyers into expensive but performing high CASA private banks, or you would look at the PSUs or the corporate facing lenders?
So still bullish on private banks, high CASA, and again B2C kind of lending portfolios. Obviously they will feel pressure because of the overall global sell down from the FI side, and obviously as an investor I would like to buy at a lower price. So whenever we go into buying mode, we'll buy slowly, steadily, rather than just sticking your neck out, because as I said, next 3-6 months are pretty critical for us, generally from the economy perspective. So we are still trying to play those stories, because we feel that the credit costs are under control, NPA issues still not there, and the banks have been growing at 20-25%, which is good growth in the scenario where even credit growth of just single digits.
So when currency slips, people typically start buying these big exporting sectors like IT. But is there a strong medium to long-term fundamental case for IT?
See, that might be a trading bet, but we genuinely feel that unless and until you have a growth, you have a top line, these are all very, I would say, very short-term factors to believe in. And I don't know how much they will be able to manage margin, because there are other cost pressures as well.
12-13 times cash flow generating companies.
So they are good. So see, it depends on your philosophy, what kind of philosophy you are running in the portfolio. So we normally go for a growth kind of a philosophy. So it is not that we don't have anything in the portfolio, but we would like to play a slightly higher growth stories which are more domestic driven. And once we get a sort of a understanding that now from here on, you have a technology sector or a pharma sector which is again going into that 10, 15, 20% kind of a growth trajectory. So 10 to 12 more for technology and maybe 15 to 20 more for the pharma company. We'll definitely look into it. But as of now, the kind of channel checks we are doing, we are not getting those kind of fillers coming in. And I think even companies are very open to tell you that things are not that great, as I think many companies are organizing preview before the results meet, and the BFSI and the retail segment in US is still under pressure.
So, but you may not get this this price, really, what we see today.
So you add slowly. You don't just go out just because you want to be contrarian. See, our philosophy is to play growth. Ultimately, if there is growth, you get returns, you get ROEs, you get everything.
Sure. So are you adding IT and pharma, or you are waiting for
incrementally? Yes, but not in a big way.
So we have a large pharma company coming up next, Jinesh. Lupin is about to join in.
Yeah.
Is the model seriously challenged for the next 12 months, and therefore you're waiting for that because a lot of reports have suggested that? Or is it a factor of valuations purely?
No. I think, please understand, there is destruction everywhere. There is disruptive, business models are getting disruption. So when you had a pharma company, when everything macro was good, let's say US was good, it was just a question of valuation. But suddenly you are seeing that even one of the largest generic company like Teva is facing pressures. So obviously there is some change in the business model. So you have to really be careful where you are investing your money, and we have to be agile in terms of the companies who are ready to go to that level.
Okay, great. Good having you, Jinesh. Thanks so much for taking the time out and joining us, and look forward to have you more often on the forum.
All the best for your new ventures.
Thank you so much. Thank you so much, Jinesh. Thanks for joining in. Well, the market's looking slightly sluggish at the current point of time. What we'll do is take a very quick break, but we're talking about IT and pharma, and we'll continue doing that. On the other side of this very short break, Ramesh Swaminathan of Lupin joins in to talk about the company and the pharma space.
Are we live?
Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.
The Bloomberg Terminal, accessed only by over 325,000 marquee investors across the world until now.
Just business news, we're news for business people. Welcome back. You're watching Indian Open. We have with us the CFO of one of India's leading pharmaceutical companies, Mr. Ramesh Swaminathan. Thanks very much for joining us this morning. Let me start by asking you about the quick question that we're asking everybody in industry right now, and that is, are you seeing a waning of the GST-related problems, whether they were relating to how consumers were viewing some products and prices, or supply chain and dealer issues? Is that now behind you almost?
I would say yes. May and June were months where we were tremendously impacted, but we saw normalcy returning in July, and August also turns out to be good. September turned out to be good till date. So essentially, if we believe that demand is back, the offtake is back, so I think the Indian market is certainly turning back to normalcy.
Should we expect any large costs this quarter that's underway in terms of one-time costs apportioned to GST? Because I know many companies like yours, even in the consumer space, have had to absorb some dealer losses on stocks, etc., etc. And of course, then putting in all the infrastructure in place for GST. One-time costs, but should we expect that for the industry?
Yes, for sure. That is certainly would be part of, in fact, quarter two results. There were reimbursements to the trade, and there's of course, losses on account of deemed credits at our end as well. So both would actually be.
Okay, so let's now talk about the business and fundamentally how it's doing. What's the second half looking like for you? The big pressure point has been the US. Can you talk us through what you see coming up in the next few months?
US has been lackluster performance this year, more because of the fact that we had a pretty large base. As you'd be aware, both Fortimet and Glumetza came under pressure, more Glumetza, and that's the reason why, in fact, the Q1 results were impacted. And we had actually anticipated this and gone public with it quite some time ago. And of course, we do believe that this is perhaps the worst year. Next year onwards, things could be better. Because we've got a pretty rich pipeline. Next year, for example, we do have a lot of good products to bring into market. But I would think that the normalcy would actually return in 2021.
In 2021?
Yeah.
So are we going to continue to see a drop in your US revenue over the next 2 quarters?
No, I think this is going to be the worst
Are we
year.
stabilizing from here, or from this second quarter onwards, or will we continue to see cuts in your US business for the next few quarters as well?
No, what I'm saying is this year could be the worst, and after that I think you would see growth next year, but it's certainly not coming back to normalcy. It'll be a couple of years before we get to those levels.
So you're preparing us in the sense for the next few quarters, aren't you?
That's only for the US, but we've got a lot of other growth engines also. It is about 45% of our business, and you would recognize that you've got a pretty rich pipeline coming in for that. And of course, we talk about the medium term, you've got a very rich pipeline with the respiratory portfolio, complex injectables, and a host of other things, and of course, derma products and the like, and biosimilars also. But having said that, US is, of course, a very important engine for us. The other engines, of course, would be Japan, which continues to do fairly well. India would, we think secular growth for the next several years to come. Emerging markets of Latin America, Brazil, and Mexico continue to do well. South Africa does well for us. So we have a lot of small engines also firing up.
I know Neeraj and Neera want to ask you questions. I just want a quick question on the revenue opportunity of the new launches that you spoke of. Can you talk us through that right now? Since you mentioned a few, some are already expected, we could put in names. If you give us a sense of what the new launches are.
So we have products like, for example, ranolazine coming in next year. Levothyroxine could be another product. Then you have the Velcols and Renagils, Renvilla. All of these could potentially come in next year. Or Seltamavir could be another. So all of these are products, but nothing in the same league as a Glumetza.
No, it is.
But having said that, these are all.
How large are these revenue opportunities? Will they benefit your margins in any substantial material way?
In a general sense, you would expect that anything in the tens would certainly be a decent product for any generic company, and that's where we are.
In the tens of millions?
Tens of millions, for sure. That's
in
what I
the
meant.
Tens of millions?
Yeah.
Okay. But that could be anything, anywhere between 10 to 100 million. So
that's for sure.
These are what, 50 million products, is it?
They are big in them, but there's competition, and all of that. So of course, there are a couple of products that we have, we do expect exclusivity. But having said that, there would be, and this is, the generic industry is all about a huge upside on launch and then a continuous downside.
Yeah. So actually, that's the key. I was just wondering how difficult does it become to forecast internally as well? What could happen over the next 2 years, considering that you and your peers and your colleagues, Nilesh Gupta, for example, at the investor conferences was saying that with the business models being challenged in a big way, how difficult does it become to forecast what's the kind of growth opportunity and the growth that the company could clock in over a 2-year period?
It is, business in every sphere is becoming disruptive, but in the case of America, it's more because of price erosion, and this has happened only because of the fact that there has been channel consolidation which has happened.
Yes.
The situation that we are in terms of Glumetza and Fortimet was perhaps unique to us, but there is, of course, a patent cliff also, so to the extent the number of products that we can re-engineer to bring to the market is also coming down. But that's we kind of expected all of that, and that's why we moved on to more complex generics, moving on to specialty, and that I think would be the order of the day when it comes to most generic companies.
Which is true, but my question purely is that if channel consolidation is going to continue to exert pressure in the near term, how long is the near term? Is it 6 months? Is it 18 months? Or is it difficult to say that right now?
But as I said, the generic industry is all about a huge upside on launch and a continuous downside, right? And that's the number of competitors could go up from 4, 5, 7, and so on. And of course, there is, of course, the channel consolidation piece also.
Right.
Next year could be another, spike only because of in terms of price erosion, only because of the fact that you expect Express Scripts and Egon Disc to come together. That could potentially unleash another round of price erosion, so to speak. But in a general sense, the channel partners would also like to partner with companies who have a good record of supply chain metrics, quality and all of that. And that leaves us with very few competitors. So in that sense, they would also recognize it's rocking the boat too much will not really yield results. It's going to be counterproductive in that sense.
True. The other question, and I'm sure Ira and Minka have some other questions too, but if you were in this race, and as you have to be, to increase your share in complex generics, I'm guessing it involves substantial new expenditures of a nature that you didn't have to incur until now. Maybe distribution, maybe further reaching out to newer players as well. Is that the principal reason why your guidance for margins has come off? And would you believe that operationally you would probably be in the same range for the foreseeable future, the next 18 or maybe the next 30 odd months?
So let me answer this question that way. The complex generics and the specialty piece that we're speaking about would actually call for deeper pockets because it calls for clinical trials and the like. Specialty, of course, it also calls for skill sets of a very different kind. In some ways, our generic organic strategy has to dovetail into our inorganic strokes pursuits as well. Because we need to have legitimacy with the doctors, which is very important. And of course, you get to own that space, and that's where M&A really comes in. And that would call for deeper pockets again, and of course looking around and the landscape and picking out the right opportunities and all of that. And owning that space, of course, calls for skill sets of a very different kind. Clinical expertise is very important when you talk about organic endeavors also.
Yeah,
all of this is going to be deeper pockets for sure, and that's why you find that R&D expenditure has also been rising over time. So it used to be 7%, 9%, and it's now closer to 13.5%. But again, if you look at, in fact, bigger pharma, ethical pharma, it's close to 18%. I'm not for a minute saying that our expenditure base is going to go to that level. We would do what it takes to kind of contain it around 13%. But you also need to look at innovative ways of going about it in terms of perhaps partnering with the finance partner who would take on the full risk and potentially some part of the upside as well. But given the fact that a lot of these molecules have huge potential, what you would actually be sharing with them would be a smaller part of the overall upsides.
But so all of this leading to what? A consistency in the current margins, which are a bit lower than what you historically have enjoyed for the next 24, 30 odd months?
In this range, it's going to be muted.
21 to 23 is what
about
you guided
20 to
for,
23 is what we believe it would be.
And this is factoring in the additional expenditure on whether it is
all of that,
the organic plans or the inorganic plans.
All of that. But having said that, the depreciating rupee was actually, it's certainly going to give some upsides, but an appreciating rupee would have taken away that and so on. So to that extent, there are a lot of moving parts also out here.
Yeah,
but of course, the most important factor is R&D, which of course, is what we already explained.
Can we pin you down to some more specifics when you say inorganic strategy? What kind of size of businesses in this space, in complex or specialty generics, would you be interested in? Where would you see some sort of value addition to your efforts? What kind of outlay are you looking at for M&A?
So we have always professed our interest in women's health as well as the pediatric space. That's because we've got a franchise which has been around for some time. We already have a couple of products in both categories. Suprax, of course, was our anchor product in the pediatric space some time ago. It's come down substantially. But having said that, we are looking around for assets in the women's health space, and there are quite a few there in the market. Having said that, the sweet spot for us would be between $150 to $250 million per tranche, and we could do multiple tranches of this.
Per tranche? Explain that to me. Sorry.
So potentially one molecule, we could.
Okay, so you'd be buying products, not the companies themselves.
It could be companies. It could be a, it could be a product. It could be.
So how much have you put aside, let's say, for M&A? Or how much have you
earmarked? If you look at our balance sheet, I think we've got capacity to borrow about $1 billion more. But that's, so. And
so you started with $150 to $200 million, and you just told us that you have the ability to leverage $1 billion.
We could certainly do that, but having said that, it's not as I'm going to expend that entire amount in one tranche. It's going to be, as I said, across multiple tranches and over time.
So you'd be comfortable to spend about $1 billion on an inorganic strategy to be able to build out the complex and specialty side of the business.
For sure.
That's a
Having
fair
said
way.
that, there is also continuous accruals. A lot of the pipeline is still rich. So I think the cash flows are pretty steady.
There was some news, just to tie up to that question, there was some news of you looking at a controlled substance plant overseas.
We already have one. We have it at New
Another
Jersey.
one that you're looking
no,
for?
That's
No, you're not
true.
looking for that.
No.
Okay.
Yeah. Regulatory issues. What's the latest on both the Goa and the Indore facilities?
We believe that these issues will not get escalated, and there's a lot of optimism to believe that it will get sorted out in the next few weeks, if not within the quarter itself. Yeah.
I'm sorry, I don't know, but I know you've been saying that for a few interviews in the past as well. So what is it that doesn't, is there no clarity and therefore you can't tell us more, or is it just difficult at this point
I think
in time to commit to?
all those issues that are raised with us, we've actually answered them satisfactorily, we believe.
So when do you get the next review, or when do you think that you might get clearance on this?
As I said, anytime now. It's going to be a question of a couple of weeks, or it could be a few months, a couple of months at very worst.
Okay. How is your India business looking? I mean, so much has been said and done about price control, etc., etc., etc. I won't repeat all of it, but I want you to give us some forward-looking idea, even if it's just strategic.
In a general sense, I believe that the market is pretty good. It's a secular growth rate of around 15 to 18% is what you could expect from our company. The market could go at 10 to 12%. If GDP growth is going to be around the 6 to 7%, and that's what the government's intention is. But the fact is, even the new policy, there's a lot of emphasis on, in fact, expanding the NLEM, on affordability, really. But the issues really are on awareness of medicine, accessibility of medicine, availability of medicine. I think if the government does a lot more around that and builds infrastructure for those to take off, the growth could be much more.
We are always the land of opportunity. Ramesh, I don't know when in the past or in the future will anybody ever say that there is not opportunity in India. It's just the ability to actually see it fructify in any fashion, right?
I would think so. In the case of healthcare, I think it certainly would fructify.
So what are margins looking like in the Indian side of the business?
Oh, it's always been fairly decent, but it's more an ROC game. So we find a lot of the returns from our capital employed to be tremendous in this part of the world.
Yeah. Neeraj, sir, you want to ask?
No, just a couple of things. So you obviously stated as well, I think on multiple forums, that you and almost the industry would need a slew of new launches over the course of the next few years to, in a manner of speaking, stay relevant. I'm not using the term exactly, but stay relevant. How difficult would new launches be, maybe not for you, but for the industry at large, in the face of the fact that plants are not still getting cleared at the pace at which the industry would like them to be?
Plans, are you talking about the GIDUFA?
No, I'm not just talking about Lupin individually. I'm just talking about the industry at large. The last 1.5 months, we were thought that the industry is now getting out of the hole, only to find a bunch of your peers, the observations sounding a lot more critical. For the industry at large, if new launches are the only way to stay relevant, but plants are not getting the clearances, how would all of this shape up then? There are two parts to clearances. One is, of course, products are getting, expedited approvals are in place with GIDUFA, and that's actually being demonstrated, seen in action, really. The FDA is a lot faster in terms of clearing products for launches today. The second part of the question relates to, in fact, the stringency on part of the FDA itself, and they are a very objective, and they are a governing body, and we respect their action that way. But there's a slight twist in the tail there. The fact of the matter is, for example, we have a facility at New Jersey, and it gets inspected by, in fact, a local branch of the FDA itself. And when there is a bill or a Brown coming in there, is essentially there's a context to it, because he's been there, he knows what it's all about. Every time there is, this facilities in India get inspected, it's a new team, so to the extent the context is lost. And they look at, in fact, a lot of, today they would like to look at a digitized record, and that's where it is, In the past, you had companies looking at with integrity problems and so on, but that's not the way it is today. Right. So I think so. Okay, so you believe you are completely confident of new launches from Lupins, and if not in this year, then in FY19, coming up at the pace that you are envisaging right now?
Yes, that's for sure.
And growth will come in only in FY19 as a result of the new launches.
FY19 there would be some growth, but FY20, 21 is when I think that there could be more growth because of, in fact, the newer filings that you're talking about, essentially from the respiratory portfolio, the injectables portfolio.
But Ramesh, you didn't give us a revenue opportunity number for the new filings. I tried, but it didn't work.
Well, that's what it is, so we don't give guidances.
Not guidance, but the revenue.
In a general
some size
sense,
of
I think,
what you
said,
might be having in the pipeline for FY19.
I said that, and I told you about.
No, in numbers.
That's difficult to actually conjecture.
Would it be conjecture?
At this stage, I don't want to do that.
Okay, fair enough. All right. I think a last question on what you see is the bottom line impact over the next 2 years. Will we see improvement substantially? Again, I'm trying to pin you down to some sort of number. I think you might not give it to me, but do you see that happening in FY19 and FY20?
FY19 will be certainly better than the current year, and it will progressively get better.
Okay, we'll just stick with qualitative descriptions, is it? All right, fine. Thanks very much. I know, like you said, your industry is going through disruptive forces, and it'll be interesting to see how you come out of this on the other side of things in the next year or two. Ramesh, thank you very much for joining us here.
My pleasure. Thank you very much.
Yeah. Thanks so much, Ramesh, for joining in. Well, that's interesting. That's Lupin, of course, and the Pharma pack. It's probably doing okay. I think the index, by and large, guys, is doing reasonably okay. Flat as flat can be, but that's not bad because midway through trade, we did dip only to rise and now currently trading at the highest point of the day. It's not bad. Okay, I think we're going to leave on a sad note for a man who built an industry that not everybody approves of. But Hugh Hefner, reports say, is dead today. The man who created the Playboy empire died at the age of 91. He was once called the prophet of pop hedonism by the Time magazine. He came out with the first Playboy magazine at the age of 27 with Marilyn Monroe on its cover. The picture, though, had been bought from a local painter, and Hefner, in fact, had never met Marilyn Monroe in person. But that's just one of many stories that populate his very, very colorful life. And that's it. It's the end for Hugh Hefner and the empire that he built out, which I think has anyways passed hands a long time ago. So that's the bye-bye today on Indian Open, and we'll leave it up to the FNO show to take the news forward.